Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tuning in today. It's spring, it's beautiful, the sun's shining, the flowers are blossoming, life is good. This is episode number 380. How long will $1 million last in retirement? I know you're going to love this episode, but before we get started, I like to get the day started with a verse, and so this is Philippians 4, 11 and 12. I am not saying this because I'm in need, for I have learned to be content, whatever the circumstances. I know what it is to be in need, and I know what it is to have plenty. I have learned the secret of being content in any and every situation, whether well-fed or hungry, whether living in plenty or in want. And then, of course, I've got something to put a smile on your face, and since it's spring, why couldn't the flower ride its bike? It had lost its petals. One more. How excited was the gardener about spring? So excited he wet his plants. Okay, in this podcast episode, I want to explore this question. How long will my money last? Or more specifically, if you've saved $1 million, is it enough? Can you retire and have the lifestyle that you want? In order to create and test this scenario, we need to make some assumptions. So here's the data that we're going to use to explore this question. And someone recently said, how could you have saved $1 million and not know if you have enough? If you're thinking the same thing, you might be surprised at how this scenario plays out. My assumptions are, of course, hypothetical. Hypothetical means that it's make-believe. This does not actually represent a real person or a real couple. So here's the scenario. We've got a married couple. They're both age 62 and they just retired. He has $1 million in his IRA. His Social Security is going to be $2,500 per month with 2% cost of living adjustments per year is what we're going to assume. And she's going to have $1,500 per month with 2% cost of living adjustments for Social Security. Now, these numbers for Social Security are higher than is likely to be expected if you're starting your benefits at age 62. But again, this is just hypothetical. Now, I'm going to assume that he dies first, and then she steps up to the higher Social Security at death. And let me just give you a quick example as a reminder about how Social Security works. Let's say that he has his Social Security that's $2,500 per month, and she has $1,500 per month. Combined, they have $4,000 per month of Social Security. Now, if he dies, and you remember her Social Security was only $1,500 per month up to this point, well, what happens is she gets to step up to the higher of the two benefits. So together they had $4,000 per month. Her benefit represents $1,500 of that. But once he dies, she gets to step up to the higher benefit. So now she'll have that $2,500 per month of Social Security coming in. The other thing that I'm going to do is when one spouse dies, I'm going to reduce the budget by 20%. At his death, I'm going to assume that she won't need to spend quite as much because now there's just one of them. The good news is that this hypothetical make-believe couple did spend some time really detailing their spending, and they feel like that they can have the lifestyle they want if they have about $80,000 per year of income starting out, and of course that income is going to increase every year with inflation. The average inflation rate for the past 30 years has been about 2.5% per year. So let's just assume going forward that it's slightly higher than the average, 3% average inflation for the remainder of their retirement. Now, I know we're going through a period of very high inflation, so if you decide to create the same type of scenario for your situation, maybe you're going to want to assume even a worst case and say 4% or 5% inflation. I mean, that's up to you, but 3% is higher than the last 30 years. We also have to make some assumptions about life expectancy. Ultimately, what we're trying to know is how long does their money need to last? In this case, we're just going to use the mortality data from the Social Security Administration, which puts his life expectancy at age 82 and her life expectancy at age 85. The other tricky thing about this is the rate of return, and we need to make some assumptions about what that $1 million in his IRA is going to grow at every year. I heard a guy recently say, well, the stock market's averaged 10% per year, so I'm just going to assume that that's what we're going to get going forward. And let me tell you, that is so dangerous. This is potentially a huge mistake to be overly optimistic about future returns being so high. We only have to look back to a time period like 2000 to 2010, which we now call the lost decade, where the S&P 500 went nowhere for 10 years. Remember, past performance is no guarantee of future results, but it's certainly possible for stocks to trade sideways or down for extended periods. We do need to assume that our money's going to be growing, and so we want to make projections about the future. I always like to say, hope for the best, but plan for the worst. Hope for the best, plan for the worst. So how do you come up with a conservative assumption? Well, we can look at what has happened historically, returns for a very simple asset allocation. So if we take 60% U.S. large cap and 40% 10-year U.S. Treasury bonds over the last 10-year, 20-year, and 30-year periods, that will help inform our decisions about what has happened in the past. Now, let me just say, I don't recommend only a 2-asset class strategy. In fact, nothing in today's show should be construed as a recommendation. This is not a recommendation. We're just trying to unpack this question of how long will $1 million last in retirement. But we do have a lot of data about large cap stocks and treasury bonds, so it makes it easier to analyze a simple 2-asset class portfolio. The 30-year compounded annual growth rate, assuming no portfolio withdrawals, that the portfolio is rebalanced annually, and assuming that you're paying 1% per year in fees. So if we look back 30 years from 1991 to 2021, the compounded annual growth rate would have been 8.5%. Over the last 20 years, from 2001 to 2021, the compounded annual growth rate would have been 6.39%. And from 2011 to 2021, so the last 10 years, the compounded annual growth rate was 9.56%. So it gives us an idea of what has happened for the last 10 years, 20 years, and 30 years. With asset and equity prices stretched on the high side, at least based on Robert Shiller's cyclically adjusted price to earnings ratio, and after enjoying 30 plus years of falling interest rates, we now find ourselves in a rising interest rate environment. And so to be conservative with our assumptions about the future, let's just for the sake of this exercise, take the last 30 years, which has been an 8.5% return on the 60-40 portfolio, and assume going forward that it's worse. It's about half. We'll just call it 4% growth rate going forward on this portfolio. But I found that it's better to aim low, and if things turn out better than expected, that's a good thing. What is not a good thing is to aim too high with our return assumptions, and then that may cause people to overspend only to find themselves running out of money before they run out of retirement. So again, hope for the best, plan for the worst. In this scenario, we're just going to assume a 4% annual growth rate. An interesting data point that you hear a lot of people in the FIRE movement talking about is the 4% rule. If you're not familiar with FIRE, it stands for Financially Independent Retire Early. The research based on historical returns has shown that a 4% withdrawal rate would be a sustainable amount on an inflation-adjusted basis to take out of investments every year and not have to worry about running out of money in retirement. Some people argue that 4% in today's world is too high. One of the things about the retirement budget calculator is that it takes all of this information and it makes it very real and very personalized. In this particular example, the initial withdrawal rate is only 3.5%. Remember, they're going to have $4,000 a month or $48,000 a year of combined Social Security in this example, and they want to spend $80,000 per year. So that means they're going to need to take out about $35,000, including a little bit extra that they're going to need to cover for taxes to help supplement their income. So if you have $1 million and you're drawing $35,000 out per year, that's a 3.5% withdrawal rate. Of course, I was using the retirement budget calculator to create this scenario. You can do the same thing on your own if you'd like, but a really cool new feature that we just added to the calculator is to show you how much you will pay in taxes over your lifetime, assuming, of course, that tax rates stay constant, which that's highly unlikely given the way that we see Congress tinkering with the tax code all the time. But in this scenario, we see that the lifetime taxes will be about $279,000 over the remaining joint life expectancy. It's important to remember that the money you have in tax deferred, such as 401ks, 403bs, and IRA accounts, all of that money doesn't belong to you. Some of those dollars are likely going to be earmarked to your favorite uncle, Uncle Sam. So now that we've got all of the data, how does this plan work out? Well, When he dies at age 82, they still have $433,000 in the IRA. When she dies at age 85, they have $154,000 remaining in that IRA. We could say that this is a success because they didn't run out of money in retirement. And ultimately, I think that's what most people are trying to accomplish. It's at age 87 that their $1 million would have been depleted down to zero. So should one of them live into their 90s, which is not unrealistic, they could be in a situation where things get pretty tight. Now, one obvious problem with this scenario is that it assumes that their spending increases at 3% every year, no matter what. One thing I've seen when working with real people is that oftentimes people start to slow down in their 80s. When they go out to dinner, they split a meal. They travel less. They no longer have a need for 2 cars. The flip side to that is while that spending in some instances may be reduced, sometimes spending on things like doctor's visits and prescriptions can increase. So keeping the spending constantly increasing at 3% per year may or may not actually happen that way. There's a lot of moving parts in a retirement cash flow plan. The important part of a plan is not laying this all out and then forgetting about it, but it's making adjustments as you transition into and through retirement. More important than having a plan is the continued process of planning, making course corrections as needed. It's in the planning that you will achieve the confidence that you're looking for. I found that no matter how much you've saved, people always adjust their expectations and their lifestyle to their assets. A friend of mine once told me that the luxuries of yesterday become the necessities of today. The reason I put so much emphasis on spending and the retirement budget calculator is so much different than every other calculator out there is because it's the one thing that you can control. You can't control inflation. You can't control market returns. You can influence your life expectancy. But out of all of the pieces of a retirement plan, the area that you have the most and the greatest influence is on your spending. The hope is that we can learn to be content and fulfilled at the same time. And that's why we started with this verse. I am not saying this because I am in need, for I have learned to be content whatever the circumstances. I know what it is to be in need, and I know what it is to have plenty. I have learned the secret of being content in any and every situation, whether well-fed or hungry, whether living in plenty or in want. And for many of you, your favorite part of this verse is verse number 13. And if you don't know what that is, I'll let you look up Philippians 4:13. Until next week, this is Jason signing out.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.